Welcome back to the podcast, everybody. Today, episode 115, we are going to dive into the top 5 gifts from the IRS. That's right, it's the holiday season. Are they really in the season of giving? We're about to find out, but before we do that, let's take a brief moment and thank our episode sponsor.
This podcast is brought to you by Legacy Lock. If you are new to estate planning or simply need to review your current plan, Legacy Lock makes it as easy as pie. Legacy Lock is a unique platform that enables you to easily complete your attorney-drafted documents conveniently from the comfort of your home or office. Your first step to this peace of mind is simply visiting teachingtaxflow.com/legacy.
Back here again on the podcast. As you heard in the intro, seen in the title, or you just read it or seen it somewhere else, we're going to talk about those top 5 gifts. That's right, gifts, not gifts, GIFs. As you know, you've probably seen enough of those on social media over the past decade. We're talking about gifts, presents from the IRS. So we're going to jump into these. And the good thing about these is if you actually are a diehard subscriber of the podcast, you've heard a little bit about each one of these as we've gone along, or I should say progressed along. But now we're going to run through them. A little bit more condensed version. And again, they're gifts. It's something that the IRS is giving you. It's up to you to use it. So best guy we can always think of to tell us exactly how to do this. My brother from another mother, but he also has much less hair. If anybody's watching this, you can kind of see I need to take a gift, give myself a gift and go to the barber. But Chris Picciurro, how's it going, brother?
It's going well. Happy holidays. And I know that I'm on Santa's good list. I can't speak for you, but I know I'm on Santa's good list, and
I'm like 80%, I'd say. I got, there's always room for improvement, right? So,
well, I would say that I'm definitely on the good list. And since it is a holiday season, that was the inspiration for this podcast episode. And the IRS doesn't give us too many gifts, but I wanted to identify my 5 favorite gifts that the IRS gives us. And these gifts are good because they're not specifically for certain high income or high net worth people. These are gifts that almost anyone can use. And I'm excited about that. And you might say, well, what do you mean? What is a gift in your mind? A gift is when, in the teaching tax flow system, we call this a gold diagnosis. But a gift is when you get some type of financial benefit and don't have to pay tax on it. Think about it like that. That's very rare. Right? Typically, we have to pay tax on it. We're supposed to pay tax on all of our income.
And I love that you came up with this title because it's something that I wouldn't say they're so easy, but these are all and we reviewed these obviously before we talked about them. There's something that so many people can take advantage of. And here I am staring down at number 1 here. I'll let you say what it is. I'm not going to spoil it for you. It is amazing to me how many people don't know about these. So basically, this is our gift. We've been gifted the gift to regift to the community. So let's run through these things, shall we?
Yeah, I've used 4 of the 5. Thank goodness I haven't used the 5th one yet. Which I will explain. So yeah. So the first one was going to be, and like you said, John, many of these, there's actually additional content. All of these, there's additional content on the Teaching Tax Flow YouTube channel. Many have their own tax TTF podcast episodes. But the first one's going to be the 1031 exchange. This is one we've used. What that means is that Section 1031 of the tax code allows you to sell real estate at a gain and defer any payment of the tax on that gain if you reinvest it into like-kind property. And like-kind property, there is a pretty general concept, right? So you can sell like commercial property and buy residential property. You can sell an apartment complex and go and buy 5 or 6 short-term rental properties. The key is, though, now we have to remember with the 1031 exchange, is that you can't take cash to complete a full exchange. You can't take cash or what they call boot out of the deal. You have to, and you can't put the money from the exchange in your bank account. You have to use a qualified intermediary or QI. So the process looks like this. I go to sell my property. before I close, I contact a qualified intermediary, let them know I'm going to do a 1031 exchange. My property sells. The funds from my property get wired right to the qualified intermediary for my benefit. So it's kind of like an escrow account or a trust account in a way. And they sit there until I buy replacement property. Now, there are rules for replacement property. You've got to identify the replacement property within 45 days. You've got to close within 180. And that's something that you're going to work with your qualified intermediary and your real estate professionals on. The point is, if you can defer any of the gain, that's pretty attractive, right? And you just deploy it into a different asset class. And this one actually could get paired with our final one, but yeah, the 1031 exchange is really a gift from the IRS.
And really, with this one, Chris, too. So, anybody that's listening to this, we talk about capital gains a lot because that is let's put it what it is. That is a giant kick in the what if you don't see it coming, right? So if somebody, say you're listening to this and you say, oh, well, I don't really know what capital gains is. Go do a little research on it. I mean, and honestly, Chris, I don't know if we've actually really broken down too much on a specific episode that I can think of what exactly it is. So maybe that's something we look in the future, but my little advice to anybody on this one, again, Chris brings the knowledge. I bring I don't know, I'll figure out what I bring one day, but, get a good grasp of what capital gains are or is, and then you will immediately realize how powerful a 1031 exchange is. So it's kind of like a secret weapon, but a lot of people don't know about it, right?
Absolutely. No, it's a really powerful tool. So I've used it myself, and in practically speaking, that the exchange could straddle over years. So again, work with a tax professional, work with the people that you need to work with to make this happen. If you're in a situation where you're selling property and you don't need the cash and you want to deploy it into something else real estate related, this could be a great opportunity for you. So that's number one.
And here's a bad example of that, of what not to do, is it's not like you calling your significant other or saying, hey, I'll call you on my way home, and you forget to call them. And then you get home and they're mad at you. If you're too late to start a 1031 in your process, you can't go back. So you need to initiate that early on. So
now it's interesting though, there are reverse 1031 exchanges where you actually buy the replacement property before you sell the property, because sometimes you have timing issues. But you can't. But once you close on a property and put the money in your account, you can't do the 1031 exchange. So definitely talk to a QI, qualified intermediary. Number two, health savings accounts. I know I talk about these a lot. They are phenomenal. They are what we call a triangle tool, right? A triple tax advantage tool. It's kind of like remember those those ninjas, that was like a triangle, the
little Chinese star?
Yes, that's a star, but a triangle. What do I mean by three triple tax advantage tool? One, when you contribute to a health savings account, you get a tax deduction for that in the year you contribute. So that's a tax deduction. You actually have until April 15th, just like an IRA, to contribute to the health savings account and count it for the previous year. Mm-hmm. So you have till April 15th and count it for the previous year. So that's number one. Number two, the money grows tax deferred. So you could have, your HSA could be invested in savings. You could actually buy CDs. Some people just leave it in a checking account, but most people want it to grow, right? And earn money. So all of the income you receive from it, as long as it's in the health savings account, is tax deferred. Part three, when you take a distribution from the health savings account, that is tax free, as long as the distribution is used for medical expenses. So that is the three-pronged health savings account. Think about it this way. You get a deduction for putting the money in, the money grows tax deferred, and it gets taken out in a qualified distribution tax-free.
That's a beautiful one. That's beautiful. Hopefully you never need it, but if you do, it's there.
Well, later on in life, you could actually use it to pay your Medicare premiums. There's a ton of flexibility now with those health savings account assets. So I hope you do need it in a way. That means you've lived long enough to use it. I mean, we're all going to have medical expenses at some point, right? So,
Absolutely.
but yeah, so that is number 2. Number 3, the Section 121 exclusion. What the heck is that? AKA, this is the capital gain exclusion from the sale of a primary residence. So if you have a primary residence and it's been your primary residence 2 out of the last 5 years before you sell it, you could typically exclude the capital gain from being taxable. Now, there are certain rules if you've used it as a rental property in the past, if you, they're unique situations, but for the vast majority of people, this is the primary residence exclusion or Section 121 exclusion. If you are married filing jointly, you can exclude up to $500,000 of capital gain. All others can exclude $250,000 of capital gain. So this is one of those 3 laws of teaching tax flow. We talk about tax flow and cash flow are different. So I'll give you an example, John. Let's pretend you bought a home. Where do you want to move, John? We shouldn't say that, but let's say you move to, where are we going to put you?
Well, let's say somewhere in Montana. Stick me out there for a while.
Butte, Montana or something.
There we go.
Cyan or anyway, whatever. You buy a home in Montana for $400,000, right? And you have a $300,000 mortgage. You live there for 10 years. The property goes up in value to $800,000. Let's assume you're married. And let's say you paid the mortgage down to $100,000. Are you with me? So when you sell that property, you have $800,000 it's worth, minus $100,000 in mortgage. You walk away with $700,000. This is where cash flow and tax flow come in. You might be saying, because this happens all the time in the teaching tax flow community, awesome, I have this house. I just walked away with $700,000. I know the first $500,000 is tax-free, so I have to pay tax on $200,000. Actually, the news is better than that. Your basis in the house, meaning what you paid for it, is $400,000. You sold it for $800,000. So you have a $400,000 capital gain, which is less than the exclusion of $500,000. So the entire $700,000 you walk away with is tax-free. That's the Section 121 exclusion.
And this one's so interesting to me. And honestly, like I really don't know it. I know we talk about this, I know the concept. I don't know a lot of the details on this one. So here's a question too. Like I feel that the older generation, they tend to stay in their homes a lot longer. So without getting into number 5, which we're going to talk about, I don't want to say what it is. We'll leave that as a cliffhanger. Yeah. So with this though, I mean, is there a caveat to this at all? Like, is there any recapture or anything anywhere down the line? Or is this basically truly a gift from the IRS that some people just may not know to take advantage of? Just like
it's a gift. Now you can only use this once every 2 years.
Okay.
And if you're not there the entire 2 years, there could be unforeseen circumstances. And I think we have a whole podcast episode just on this topic alone. So yeah, no, it's just the gift from the IRS. It's commonly thought by many of the tax planners out there that this Section 121 exclusion was put into law because of 2 years is the term for someone in the House of Representatives. Because think about this, John. You now live in Montana, not Wyoming. So I was wrong. I'm like, you live now in Montana. You become popular as normal, and you get elected to the House of Representatives. Good for you. You move to Washington, D.C., and you buy a home. You serve your 2-year term. You still have your house in Montana, right? You serve your 2-year term, and you do a terrible job, and you don't get reelected. Sorry to hear that. You then sell your house in Washington, D.C. after living there 2 years, but because the market has gone up, you make $200,000. As a parting gift, like some loser on a game show, you get to walk away with a parting gift of a $200,000 capital gain excluded from tax and go back to the house you lived in Montana. And as long as you stay in that house for the next 2 years, you can go sell that one and get another 121 exclusion, because the rule is it can only be claimed once every 2 years.
So really, with that being tied to politics, it's kind of like the powers that be. It's probably pretty safe to say that this isn't going to change for a while.
Right.
if that's the case.
No,
right?
I don't think this is going to change. And a lot of times you sell your house to the next person that's going to be in the House of Representatives.
Right.
Yeah, but so it's pretty cool. I mean, that is a really nice benefit. So up to
Awesome.
$500,000 of capital gain. Now, when you're calculating this, remember to include any improvements that you had on your house. Sometimes someone buys a new home and they put an addition on, or they do landscaping, or they anything like that, you can add to the basis when you're figuring out that gain.
And actually, before we skip along to that too, because if I can ask you this, so how many times in your career, in your private practice, have you seen, say somebody's doing their own tax prep, they're using a DIY service, and then, you get introduced to them and you're like, wow, you just sold your house a couple years ago and you paid capital gains tax. Have you seen that a lot in the past where you have to really go back and do an amended return and get things,
We
get
haven't
the
had
house
too
in
many
order?
people that we amended a return because they paid tax on it. But a lot of times before someone's going to sell their home, we're working through the tax ramifications. First of all, figuring out if it's even going to go over that threshold. And then if it does, how to plan around it, especially over the last few years in some of the higher area or some of the geographic areas that we've seen a large increase in house pricing. I've had quite a few people that are over the $500,000, which is good for you, right?
Right. Awesome. No, as you can tell, I'm
Yeah.
super intrigued with that one. So I'm hovering around the 121. So without further ado, let's keep moving along here.
All right. Number 4 gift from your friends at the IRS. It's section 280A. You're saying, what the heck is that? The Augusta Rule. Why is it called the Augusta Rule? Well, the Augusta Rule is named after Augusta, Georgia, where the Masters golf tournament takes place every year. And have you ever been to Augusta, Georgia, John? I'm wondering, because you were pretty close in Charleston.
Yep. I've actually been through there a couple of times. Obviously not anywhere near the golf course during the Masters, but
Well, there's not tons and tons of hotels, and a lot of times these golfers have a team of people or families, so they rent out a home. And what the Augusta Rule says is it says you can rent so there's a couple applications. Let's talk about the bottom line is you can rent your primary home up to 14 days without having to pay any tax on that rental income. So it's tax-free rental income, right? And it could work a couple different ways. One, it could be just somebody, like we've used this here in Franklin. We've had people, because we travel out of town for Thanksgiving and Christmas. Excuse me. We've had people during Thanksgiving rent our house for a week. And because it was only 1 week of the year, I don't have to pay tax on that rental income under the Augusta Rule. So if you own a home, you can rent it out for up to 14 days a year tax-free. So if you live you live near a certain school that I don't care for in Ann Arbor, Michigan.
you're going to say it one day you're going to say it one day. I'm prying out of you.
And when they play football games, right? You could rent your house out every home football game for the weekend, or let's say you would do 4 of them for 2 nights, or whatever. Let's say there's 6 of them at 2 nights each, 12 nights, and pocket all that money tax-free if you want it. Now, the practical part is you got to get the family out, get Cooper out of there, and that sort of stuff. But for a lot of people in college towns, near big festivals, these are opportunities to do that.
Absolutely.
Think about the Olympics. Like when the Olympics are going to be going to Los Angeles next Summer Olympics, I believe, there's going to be a lot of opportunity there. Then
with this too, so it's 14 or 15 days, and they don't have to be consecutive. Just 15
Correct.
days within a calendar year.
It's up to
Less
14.
than.
So, yeah, under 15, but up to 14 days. Correct.
Awesome.
And it's tax-free. And then there's another more advanced application of this where, let's say you own a business and you utilize your home for business. The business can rent the home out at fair market value and pay no tax on it, and the business gets a deduction. So an example of that would be someone that owns a business and has a holiday party there. Let's say you have someone that is a business coach and they have retreats there? Or what if they're marriage counselors and they have retreats at their house? There could be a lot of different applications for that. Holiday parties. But
I love that they come up with these names too. Like I would love to be in a meeting or some form where they name these, where they're having like a really structured, extremely serious conversation, and then someone goes, "Let's name it." I'm surprised they don't name it like the like that Comic-Con rule or something. It could be anything.
Well, I was thinking that the Augusta Rule, I wonder if there was someone from Georgia that came up with this. You know what I mean? Maybe if someone in the House of Representatives.
And like some laws, right, or bills that passed, they're almost named like after the lawsuit or something, right? So maybe somebody got PO'd that they couldn't rent out their house, for $20,000 a night, which they probably get if they live near that course. But this is a great one too, and I like that you did kind of bring in the other side of it from the business side of it, because that's another one. I mean, I've learned that from you a while back. That's another one I very, very, very rarely ever hear anybody mention. You'll hear the Augusta Rule mentioned a lot, but very rarely how a business could take advantage of it, which is extremely powerful,
John,
right?
Remember your first condo in Charleston, right? Very desirable area. You ended up putting it on Airbnb, but let's say you lived there all the time and it just, you knew you were going to come up to Michigan for a couple weeks in the summer to escape the heat and humidity down there. And the only time you rented that condo out was for those 2 weeks. You could have pocketed that cash. It would have been a pretty penny tax-free. Now, once you converted your property to an Airbnb and you're renting it out more than 14 days, we had to really look at how many personal use days versus how many rental days. It's just to get the tax-free treatment. It's that 14-day rule.
Awesome. Well, let's my dad joke. Here we go. You ready for my dad joke?
Oh,
let's take a swing at number 5.
Number 5, right? The number
my
5
golf joke. There you go.
Is a step up. I know that was amazing. Golf. So the step up in basis is number 5. You might be saying, "What's that?" Well, the step up in basis means that if you inherit an asset, your cost basis in that asset is the fair market value of the asset the day you inherit it. What the person that basically left it for you or passed away, their basis is irrelevant. So this is a huge opportunity. And this plays a role between spouses. There are special rules in states that have that are common law states, common law marriage states. So let me give you an example, John. Your uncle, right? We don't want to knock out our parents yet, right? Your distant uncle, he lives in Texas somewhere. Many years ago, bought 1 share of stock in an oil company for $100, right? That stock share is now worth $10,000. Your uncle passes away, and for some reason, the uncle remembered you and said, "I leave to Johnny T this 1 share of oil stock." You get this share of oil stock, and you say, "You know what? I don't want this oil stock. I want to go take my daughter on a shopping spree at American Girl store."
The stock ain't gonna get very far.
You're not going to get far for the 10 grand.
Nope.
And American Girl, if we're happy to offer you a sponsorship opportunity on the show, and we'll retract these statements.
We'll change our tune.
Yeah, we'll change our tune. We'll pick on somebody else. You go, you sell it, right? And by the time you sell it, the stock goes up to be worth $100,200. Wait, no, I said $10,200. You've got tax flow versus cash flow. You got $10,200 in your pocket. Your uncle paid, wouldn't I say, $100 for it?
Yep, $100.
That's irrelevant. Your basis in the stock is a fair market value when you inherited it, when he passed away, at $10,000. So on your tax return, you're going to report, "I sold this share of oil stock for $10,200. My cost basis is $10,000. You will pay tax on a whopping $200. That's it." That's
So
why a
with
lot of
this
times
one, Oh, no, go ahead. I'm sorry. I cut you.
Yeah, you're going to hear people a lot of times say it's much better to inherit an asset than gift it. Because if he would have gifted it to you a day before he died, you would have taken over his cost basis. You wouldn't have got the step up in basis.
And that's exactly what I was going to ask you, right? Because sometimes you might run it, and not to sound morbid at all, right? You might have a family member or somebody, and they, they're on their last, run, and they say, "Hey, I want you to have this. I want to make sure that you have this. I want to watch you have this," kind of deal. And then they gift it to you. You're in trouble potentially, right? And I mean, I can see that being an issue. Say somebody got a crazy scenario. Say somebody was, had a modest lifestyle, average household income, and then they were gifted a multi-million-dollar home that has, been in the family for eons, right? And they can't take advantage of that step up in basis. That could cause a serious problem where it's like, don't gift it to me. Like, kick the can first and then give it to you. And I get that, there's some emotional ties in that decision-making process, but I love the way that you described that as well too. It's like that really the pinnacle, or if you will, the fork in the road is really once that person is no longer an active Social Security number, or actively on the census, we should say.
Right.
Right.
So those are the 5 gifts, man. And here's one more thing. And as we wrap it up on the step up in basis, we know, because you listen to this podcast, long-term capital gains are taxed at a much less rate than short-term capital gains. The great thing about inheriting something is even if you don't own, long-term gains are triggered when you own something for a year or more. Any inherited property automatically gets long-term capital gain treatment, even if you only owned it for 2 days or 1 day. So you'll get that long-term capital gain treatment. And yeah, those are our 5 gifts from the IRS. So I hope that your gift giving and giving season is great as well. And thank you so much for listening to this podcast. We've really enjoyed it. We enjoyed doing it. We're excited about a lot of new topics, and again, run into the Teaching Tax Flow YouTube channel and hit subscribe, because we've got a lot of other content on these 5 topics and more.
Absolutely. And all the quick tips that are rolling out there, little 60 to 70 second little tips, little reels are fantastic. We got an endless amount of those. And what we'll do too in the show notes here, whether you're watching this on YouTube or wherever you subscribe to the podcast, or even just listen to it in the show notes, we'll go through and we'll put links of previous episodes that touch on each of these, because you might look at it and say, oh, I'm not interested in this one, but hey, I want to learn more about the Augusta Rule. We'll put those links in there. So look in the show notes, direct links are in there. And as Chris mentioned as well, get on YouTube, subscribe there, subscribe to the podcast if you haven't already. You'll get a notification. Usually we drop these things about 4 or 5 a.m. every Tuesday. So think about it as something you can listen to in the way into work, or put in your headphones and let your kids scream in the background and pretend like you're listening to them. Either way, it's we appreciate having it, and hopefully you enjoy the content as well. So everybody have a great week. We'll see you next week as we do the very last podcast from us for 2024. So we got a good one coming up as we wrap it up, and we'll see everybody back here again next week, roughly the same time, different topic on the Teaching Tax Flow podcast.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.